Cameron Dawson's here, Chief Investment Officer of New Edge Wealth. Kevin Nicholson, Chief Investment Officer of Global Fixed Income at Riverfront Investment Group. Good morning to both of you. I don't know if you got a chance to hear the top of the show this morning, Cameron. We were discussing, I mean, you saw what happened on Friday, and we've really been discussing whether you think the Fed is about to make a pivot and what's really happening to this economy. What do you think?
Well, we obviously saw the market rally really hard on Friday in response to this hope that the Fed would be slowing down the pace of rate hikes after the November rate hike, and this interpretation that maybe this is a pivot. Now, if you look closely at that Wall Street Journal article that talked about this slowing, it didn't really talk about inflation slowing faster than expected. That would be the most bull case here. It was more concerned that underlying growth and financial stability could be at risk if the Fed continues to raise rates at such an aggressive pace. So we always knew that eventually they'd have to slow down from those 75 basis points. We think the bigger question is how long they stay in restrictive territory, because that's what will really impact underlying economic growth. So we don't really think it's a pivot, but we knew this slowing would eventually happen.
Kevin, where are you on this?
I definitely don't think that the Fed is going to pivot, and I don't think that this is a pivot. I think that the Fed is determined that they're going to make sure that they stamp out inflation, and we're a long way from there. You have headline inflation still at 8.2%. And, core CPI has been growing as well over 6%. So I definitely don't think that the Fed is at the point that they're going to pivot.
Kevin, do you then look at what happened in the equity market on Friday and just say this is just a head fake? This is just some folks who are a little too optimistic. How do you rationalize what's happening then?
Andrew, the way that I look at it is that you have a period, you're in a bear market, and so we're going to have these moments in which we have the market go up. But, there are going to be, you're going to have these little mini rallies. But at the end of the day, with inflation as high as it is, I do not think that you're going to see multiple expansions. So it definitely has to come through with earnings. And as you well know, about 40% of the S&P 500 earnings come from, their earnings or revenue comes from overseas, and about 27% of their profits come from overseas. And with a strong dollar, that is going to impact those earnings. So I think that what you're going to see going forward is that you're going to see earnings under pressure. So I find it very difficult to believe that this rally is for real.
Cameron, what's the chance Kevin's right? And if he is, what do you do about it?
Well, I think as Kevin said, rallies happen in bear markets. It's a bigger question of where your underlying trend is, which continues to be down from the perspective of both earnings and valuation. But the challenge is that this market moves so far, so fast to the downside. That means that we were really a coiled spring for any kind of good news to see a rebound. So how to play it or how to take advantage of it is that as you see the market be weak, don't press short. Don't be too underweight into sharp market weakness. But as you see the market rally mostly into resistance, that's where the risk reward starts to become much less attractive. So we think the first level of resistance is 3,900, but then the next level would be 4,200 on that 200 week. We think it's very difficult for the market to get there given these headwinds from earnings and valuations. But of course, because positioning is so light, you could see something similar to like what we saw earlier in the summer.
But Cameron, between sort of an upside downside risk assessment at 3752 on the S&P 500, you think there's a greater chance we get to 4,200 or a greater chance we get to 3,200?
It's a matter of time. And I think that that's the whole point of bear markets is that they take time. And so you can get to 4,200 before you go to 3,200. And that's the discipline about not pressing shorts at 3,600, being able to see that the market could rally in the other direction, but then not chasing the rally to the upside. And I think that discipline is really, really important.
Okay, we're going to leave the conversation there. Cameron and Kevin, thank you both.